As we all know, the Federal Reserve of America, the central bank, has been trying to tame inflation in the US. And they do this by increasing interest rates, which makes borrowing more expensive, and also something known as QE, quantitative easing, which basically takes money out of the system. This slows down the economy, and so far, everything has been fine. Sure, there was a shock in 2022, but the economy kept climbing. And even real estate, which is very sensitive for interest rates and also taking money out of the economy, because again, people need to borrow to get a mortgage, has been fine so far. But now, cracks are starting to form in the real estate market. After a 15-year bull run, we're finally seeing it come down in a way. So what is going on in the world of real estate? The last time something went wrong, in 2008, it was disastrous for the economy. So let's look at some data and some reports to get an idea. Because believe me, if you're not aware, it could be disastrous for your portfolio. So let's dive right in. It all started with this article that I found on Yahoo Finance, which stated that more than half of US homes lost value in the past year. As of October, 53% of homes in the country had lost value in the past year, according to Zillow data. And Zillow is basically a gigantic home/real estate selling platform. Nationally, home price appreciation has been roughly flat, but that figure masks large regional discrepancies. Certain areas of the US, which have been building a lot of places and saw a lot of action during the COVID years, because a lot of people in the US were moving during 2020 and 2021, saw massive drops in value. And even if you look at the data from the Federal Reserve, which keeps track of the median sales price of houses sold for the United States, you can see that they peaked in Q4 2022, which was kind of the peak of US interest rates, and since then they have gone down. Even if you look at mortgage rates, you can see that in 2022, mortgage rates started to rise really quickly, and only went higher and higher and higher. And even now, they are still sitting around 6.2%, which is much higher than the levels we saw before, for example, during 2019, 18, 16, and to be honest, all the years after the 2008 financial crisis. Mortgage rates at the moment are at similar levels as they were during 2008 when it all went wrong. And this can be seen in the data, because across the country, the average drop from the peak is 9.7%. But, as stated here, this is on par with pre-pandemic fluctuations, and far from an actual crash. So, the housing market is in a weird place. It is cooling down a lot. But you gotta remember, a lot of homeowners, 67%, still have gains on their home. So their home is worth more than when they bought it. And you gotta remember, a lot of these people were able to lock in much lower interest rates in the years before the COVID pandemic. And they're still enjoying those incredibly low mortgage rates. But if we look at more data to get a better picture of the situation, you can see that it's not perfect in every way. It is kind of falling apart slowly. Like I said, home prices peaked in Q4 2022. But at the moment, even though it has slowed down a little bit, home price to median household income is still incredibly high. So what is going on in this housing market? Well, if you look at data like new home sales, you can see that in the longer trend, it kind of peaked in 2020 and 2021 and has since that time, since interest rates increased, borrowing just became a lot more expensive, have slowed down quite a lot. But are still relatively high compared to the pre-pandemic years, higher than 2016, for example, or 2017 even. And we recently, in August, the data is sadly enough not as up-to-date as I would want, we still saw a pretty big spike. But if we look at existing home sales, we can see that they have absolutely plummeted. A lot of people who wanted to moved during the COVID years, and now a lot of them are stuck in their homes because if they would move, they would have to get a new mortgage or remortgage, which would be much higher than what they locked in during the COVID years when interest rates were incredibly low to stimulate the economy. So a lot of people are not really selling the homes that they are living in. Nobody is moving, really. Everybody is staying put compared to, as you can see, the years before, even during COVID. If we look at new houses in the United States, the monthly supply of them, we can see that this has risen immensely. It kind of peaked in 2022 and came down a bit again, but it has been slowly rising, hitting levels that you would normally see during a recession. So while nobody's really selling their existing home, the ones that they are living in, new homes that are being built by home builders have a hard time getting sold, which makes a lot of sense because the mortgage rates are high and the price of the homes is still very high. Like the average price is high, interest rates are high, much higher than they used to be. So in general, buying a home is much more expensive. You're not going to get as big of a loan compared to your income as you did before they raised interest rates. So there is a slowdown and there is trouble brewing, but it's mostly for home builders and new people who want to get into the market. Meanwhile, if you look at total housing inventory, this has been slowly, bit by bit, rising higher and higher and higher. So the monthly supply of new homes that are available is rising, which is concerning and not great for home builders. The total supply is rising, as you can see here, and existing home sales monthly supply is rising. So even the few people who are selling their home right now in the open market, which is really low compared to historic standards, are having a hard time getting rid of it, as you can see right here. This has been slowly climbing and climbing and climbing and climbing. Anybody who is trying to currently sell a home, no matter if it's newly built or you just want to move or your grandparents died and you're selling their home, it is hard to get rid of it. And if you want to get into the market, you're probably not buying because interest rates are so high and there's a lot of economic uncertainty. The housing market is really not in a great place. But a good thing to see is that delinquencies are incredibly low, at least. However, as you can see from this chart, which compares mortgage delinquency rate to unemployment rate, you can see that it's very much correlated. And since the job market in the US has been slowing down a lot and hasn't been doing great, which could lead to higher unemployment and maybe more layoffs, we could see mortgage delinquency rates rise, which would basically make the perfect storm. At that point, we've hit every box that we need to hit. Monthly supply of existing and new homes is hitting highs, prices are going down, delinquencies are up, unemployment is up, and houses and homes in general are just too expensive and the bubble has popped. If unemployment actually rises from this point onward, like significantly, we are 100% going to see trouble in the real estate market. It is the only thing, the delinquency rate is the only thing we are missing at the moment. And a lot of home builders and a lot of homeowners are kind of lucky in the fact that the total supply of US homes is kind of low for the amount of demand that there is, which has also allowed this bubble to stay intact because the supply and demand dynamic hasn't completely shifted. There's not a lot of demand, but supply is also really low. So if supply would rise, for example, demand remains low or goes even lower, that's when you would get into trouble. But for now, due to unemployment being low and supply being low, things are fine. But as soon as this changes, we are 100% in for trouble. So again, just like I said in my previous video, which you can check out by clicking in the upper right corner, the economy is in a bit of a bubble and it is destabilizing. It is becoming more shaky. And if it happens, it's better to be prepared. And like I said in my last videos, there are ways to prepare for this. Key things that you need to keep in mind when doing portfolio management is diversification and hedges. And like I said in my previous video, one big hedge I have is based on treasuries. Again, check out the previous video if you want a more in-depth explanation. But one way I'm doing this is treasuries, because if interest rates go up, the value of bonds, treasuries, goes down. But if the Federal Reserve has to lower interest rates and stimulate the economy because we get a recession, treasuries or bonds go up. And another thing I'm doing is keeping some cash on the side. Now, overall, I am not very heavily invested in real estate. There are only two companies that I own. American Tower and NVR. And both, in my opinion, are fantastic companies. But as you can see, and as you can imagine with the current landscape, both of them are struggling a bit. Luckily enough, I kept a sharp eye on their balance sheet and their financials, so I know that they can survive any real hardships, even something like a 2008 financial crisis, because both companies have actually, in fact, survived 2008 and are currently prepared for a similar scenario happening again. I mean, they're currently already under a lot of pressure and they're doing pretty good. And as you can imagine, like I've said before, I wouldn't advise betting against real estate, because the market can remain irrational longer than you can stay solvent. Who knows how long real estate will survive? Maybe 7 times average income, this level that we're currently at, is the new normal. Who knows? Only time will tell. But one thing is certain. The real estate market is in a weird spot and destabilizing by the day. It's not great. Now, I hope you all enjoyed this video. Thank you all so much for watching. Be sure to subscribe. Check out my eToro for more articles or more info. And if you want, you can copy my portfolio so your investing is on autopilot and I am taking care of it. And yeah, be sure to check out the previous video I did on AI if you're interested. And yeah, that's kind of it. I hope you enjoyed the video. And may the markets be with you.